From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, the war in Ukraine escalating, investors ignoring a solid jobs report as Treasury yields dive and crude climbs. We begin with the big issue, gripped by geopolitics.
The market's focus is really not on payrolls.
Payrolls.
We're not talking about the payrolls report.
Market reaction is about Russia, Ukraine.
Russia and Ukraine.
Certainly front of headlines.
A much harder reality.
The fixed income market's extremely concerned.
Significant commodity shocks.
The volatility and the uncertainty of the situation.
Significant growth shock.
Another risk of supply chain disruptions.
It puts the Fed in a difficult position.
They're trying to thread the needle.
They don't have a thread the needle option.
It puts us as investors in a difficult position.
What Wall Street is generally having a very difficult time getting their head around is what is the Fed's priority?
They were already facing a dilemma.
Joining us now to discuss is Manulife's Francis Donald, MUFG's George Goncalves, and PGIM's Robert Tipp. And in just a moment, hopefully we'll hear from the President of the United States. And Francis, I think for a lot of people, they'll be focused on what he's got to say about other things, not about the payrolls report, about Ukraine. We're gripped by two opposing forces at the moment, as you know, Francis. Tragic news in Ukraine, really solid jobs report, and a bond market, I imagine, which does not know which way to look. Which way do you look?
Well, I look forward, not backwards. That jobs report tells us what went on last month before we experienced this very stagflationary shock. It was almost a secondary point for me today. I can't believe I'm saying that on Jobs Day because I was too busy running my GDP models on what this extraordinary commodity shock is going to do to what the world looks like for the rest of 2022 and 2023. So it's no surprise to me that we aren't really gripped between two forces. We're purely focused on where is the economy going next. The jobs report gave us a sense of what we already knew. The employment picture is just fine. That's not the problem facing us in the next 6 to 12 months. I don't think the bond market is torn at all.
What kind of demand destruction are you expecting?
Sizable demand destruction in certain places like Europe, in places like emerging markets, but the U.S. and other developed markets are not going to escape at this point. So we're looking at downward revisions, not just for 2022, but 2023 as well. Today's jobs report showed us that wage growth, it slowed a little bit, and we're actually looking at the sharpest real wage decline that we've seen in decades. That's not a strong environment for a Federal Reserve to be hiking in. We often hear Fed's hiking into strength. That's a good thing. This Fed is hiking into weakness. That's why that yield curve is very flat. That's why 210s are on the brink of inversion.
The low 20s right now. George, is this a growth shock? Francis believes it is, or is it an inflation shock?
Yep. It's a growth shock, ultimately. And not only that, Jonathan, the bond market's also sniffing out the potential for contagion risk throughout the European banking system related to vis-a-vis the Ukraine-Russia issue. And so we're definitely in a very precarious moment right here. If you look at the way swap spreads are behaving, look at the way that European financial CDX is behaving, there's something going on, and I think the bond market's sniffing it out.
Robert Tipp, do you agree?
Yes, I think there's a continuum, though. I think that, in the United States, the impact, you might imagine, I could imagine, could be a lot more limited on the demand side of the economy because we've just seen a 2021 that has been going through the fiscal headwinds, that has seen an average oil price of $70, not the $40 that we averaged in 2020. And the economy has blazed through that. And the job growth is accelerating. And so, if I hadn't just seen that, I would be more concerned about the U.S. growth side. But the market is trading not just a continuum, but fat tails. And the other part of the continuum is the closer you get to Europe, the bigger that damage is on the growth prospects and the fat tail. And the fat tail, aside from the obvious, black hole we can fall into, is somewhere in between where energy is cut off to Europe. And the growth outlook is severely damaged through both the supply and the price effect there. So I think it's a continuum, and the market is pricing in that probability of an even worse outcome.
Robert, you said something in your notes. You said that we're not pricing a global macro event based on what you'd seen in the bond market. What did you mean by that?
Well, that sounds like it was probably about 8 days old. I mean, the news flow you could have rationalized early on that Putin was looking for a better negotiating position, and once there was some fear out there, he was going to strike a deal. But he has gone a little bit too far for that in terms of his actions on the ground there and the retaliations against him in terms of shutting down so much of the financial plumbing between Russia and the financial world that we're beyond that. And that this is, kind of like a hot bay of pigs or, a quick, zoom right back to some proximity of Cold War. So I think, this is clearly an environment where the market has to price in a much worse outcome than what we're looking at right here based on the trajectory that events are taking.
Well, let's talk about how you'd push that through the yield curve. And Francis, I'll come first of all to you on that. 2s, 10s, you mentioned that, 25 basis points, just short of 26. 2s at the moment south of 150. We're going into a CPI print next week, which could be close to 8%. We've just had a payrolls print that's close to 700,000. Does it make sense to be down here at 150 on 2s?
Yes, because that's what's going to happen over the next 2 years. Now, let's make no mistake, the Fed has almost no cover to go dovish here. I think Powell did what he could to say, we'll go 25 basis points. He's got that old quote, when you're walking through a dark room, you go slowly so you don't trip over furniture. I wouldn't be surprised if he uses that one again. But there is limited cover in the data for them to turn dovish, even on a forward-looking view. So we can expect that we're stuck in this too hawkish for a slowing growth environment for another month or two. But as you know, John, I do expect that we are going to have to see a pivot from those central banks, that they are going to have to take some of those rate hikes out of the next 2-year horizon. There will not be a strong enough economy to deal with that. And we're going to see central banks who are forced to shift from the inflation narrative towards the growth narrative. Until that happens, expect that yield curve to continue to flatten.
Well, Francis, the last time he was in a dark room, inflation was 2%. Now he's got this screaming monster called inflation at 8%. Can you actually go there slowly this time around? And forgive that, because that was a really bad joke. But can you actually go that slowly this time around? Do you think that they'll be willing to? I mean, this is what Deutsche Bank's Matt Lazzetti had to say. A more cautious initial approach does raise the risk of having to move more aggressively down the road. Do you share that, or do you just really strongly believe that growth and the growth story takes over in the back half of this year?
Well, I think they're going to get an opening and that inflation will begin to soften. Now, less so that we've seen the Russia-Ukraine shock. That's going to keep inflation elevated. But central banks, from the ECB Lagarde to the Bank of Canada's Tipp are really trying to emphasize here that rate hikes are going to do nothing to solve a war in Eastern Europe and can do very little to bring down those oil and food shocks. So if the central bank wants to pivot, they're going to have to go back to the messaging that there's inflation they can control and inflation they cannot. And frankly, for American citizens, I think that would be the right thing to do, because we're still asking central bankers to try to solve a problem that is not part of their tool set. Most of the inflation in the system cannot be solved by higher interest rates. Whether you go 50 or 100 basis points, it's going to have very limited impact on energy and food prices.
George, I have a lot of sympathy with anyone who's got to put together some forecasts. And on March 16th, the Fed has got to put together some forecasts in the summary of economic projections. What does the dot plot look like in your mind, George? How do you think it evolves?
Look, I think they're going to obviously put in more hikes into the dot plot. But I think what we really have to take a step back, and again, I'm going to bring back the idea of dollar funding and the issues around liquidity. I mean, central banks fought long and hard coming out of COVID to make sure there was, really proper functioning markets, and a lot of QE was spent doing that. And now, if we do get into an environment where liquidity becomes an issue for the next couple of weeks and months, how aggressive can the Fed really be when they know that the ultimate central bank of the world? And so, if ECB probably gets pushed back on in terms of their hikes, the Fed at some point is going to have to look up and say, is this really just a systemic problem to Europe? Does it spill over into the U.S. economy, but also U.S. markets and financial system? And at that point, I think we really have to ask the question: do they go ahead with quantitative tightening? Because they can hike. I mean, hiking is not going to be an issue, but the biggest issue, and the elephant in the room always for me since day one, how do they shrink the balance sheet in environments like this?
One thing that we've been following is company after company pulling back from Russia. The Russians are pushing back too. This from Interfax just a second ago. The Russian watchdog says it blocked Facebook in Russia. We've had company after company. The issue that I'm seeing play out too, Robert, is that a lot of people want to exit some of the trades they've got on, the exposure around Russia, and the gate's shut. They can't get out. The stock market's still closed. I've got no idea if it opens up at some point next week. Robert, Tipp, do you think we fully realise the consequences of that? People rushing to the exit, the doors shut. When do you think we start to see that?
I think a lot of it happens in very short order. I mean, the prices of those bonds, this is not something where they're, taking 6 months to go from 100 to 20 cents. It's happened in a week. And there's very little support there from distressed investors to buy. The saving grace is that Russia is a very strong country as a credit going into this. And so they did not need to borrow a lot in international markets. And so it's kind of like the China housing situation where that market is imploding. It is a major event for China. But when you tally up how much foreign currency debt those issuers had, it's very small. And in the case of the Russian government, that is the case. And for a country of their size overall, it's more muted. So I think, the problems you're going to see, people are going to figure them out in fairly short order.
Anyone keen on taking the CDS question from me just quickly? George, I feel like you might want to go there. If you've got any idea when you speak to people, if a Russian issuer actually looks to pay the debt but it doesn't get cleared, is that a credit event, George? Have you spoken to anyone about that? These new rules that you can't pay foreign owners of local currency debt, if they try and pay it but you can't clear it, the pipes don't work, they're not efficient, just so to speak. Is that a credit event, George?
Look, I'm not going to go there, Jonathan, just because, I think it's, there's a lot of, interpretation in given what's happening with the sanctions and how it was put in place. I'm not sure that some of these contracts were written to understand it like a forced collapse in cash flows and payments. But I do think your point is well taken, and this is what I think we're probably seeing. It's hard to get a handle on what's going on within the European banking system, in between, the petrodollars that are supposed to be circulating. Do people want to touch them, considering that there's a lot of self-regulation going on now as well, because you don't know if the next sanction is going to, really stop that carve out from the energy side. So it's a really tricky spot right here.
George, you're going to stick with us alongside Robert and Francis. Looking at the European names today, UniCredit at the close down by 14.6%, Raiffeisen down by more than 11%, and some of those names losing a quarter of their value in just a week. We're still waiting to hear from the President of the United States. When he comes along, reaches for the podium and starts speaking, I'll take some of that for you. The headline we got from Interfax just moments ago, the Russian watchdog says it blocked Facebook in Russia. Coming up, the auction block, corporate debt sales freezing up with geopolitical concerns returning to the forefront. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. Just waiting to hear from the President of the United States. When that news conference with him starts, we'll go to it. Let's get to the auction block, where we kick things off over in Europe with the worst week for debt sales this year. Total issuance falling short of 16 billion euros and ending with another zero deals Friday. In the US, Energizer and LSB Industries selling upsized junk bonds on Thursday, capitalizing on improving sentiment and driving the weekly tally to more than $2 billion. And 3 days of relative calm allowing the floodgates to open in high-grade debt markets. Weekly sales topping 50 billion with 9 deals coming on Thursday alone. Back with us, Francis Donald, George Goncalves and Robert Tipp. Just waiting for the President of the United States, guys. And just as we reflect on the issuance, Francis, do you get the feeling that we're about to repeat Q4 18, or is this just a very, very different story?
Well, what I'll say here is when we make a long list of recession indicators, a good amount of them are flashing yellow or red, and that sends us a lot of concerns. But the really big missing element of the recession possibility story is credit, which has seen some movement but is still relatively solid. And that's one of the reasons why, even though we can speak to a lot of the challenges in this economic environment, it's going to be very difficult for a lot of economists to really pull the trigger on that call until they see something that looks a little bit more Q4 2018.
High yield very supported by the energy rally, particularly in the United States. High yield, triple C's, I believe, Robert, we're actually doing pretty well, even with some of this mess going on. Robert, Tipp, can you run me through whether you see any signs of stress at the moment in any places that you're laser focused on?
Yeah, that's a great question because, to your point, in 2018 and even just taper tantrum back in 2013. Those were periods were extremely jarring for the market. This market has really been crash tested. I mean, we've priced in 200 basis points of rate hikes at some points. The markets are braced for QT. They're braced for the Fed to stop buying. And as George mentioned, I mean, that's an empirical question, how well they will do with the QT. But they've taken a lot, and they've held up pretty well. And the news flow has been awful, and obviously the risk markets away from Europe in particular have done very well. They've been weaker in Europe, but even there, considering what's going on, they've done well. So I think, that suggests that the markets are, pretty well insulated for this. The one place where we have seen stress, though, and we've seen it intermittently for a couple of years, is in the RV market for treasuries, in relative value, in the fine tuning, in the financing markets. And it's amazing that with all the liquidity in the system, with all the facilities that are out there, some of the limits on bank balance sheet, it's unclear exactly what it is, but a confluence of those things very quickly leads to illiquidity in short-term markets and disjunctions in treasury valuations, which is obviously one of the most liquid markets. So it's a bit surprising.
George, I know this is a topic that gets a lot of attention from you as well. The signs of stress that you see from where you're sitting, where are they?
Yeah, so I think, the idea that there's stress building in the treasury market is an interesting one, too. There's liquidity everywhere, but not a drop to drink. And I do think that in a way we were blessed that we were so concerned about the Fed and central bank tightening for the first 2 months of the year that, bond markets have clearly digested that dynamic, probably taken the curve way too flat. And by doing so, a lot of the RV opportunities naturally come out as well. But we also, have a bond market that is worried about crowding out effect. If indeed the Fed goes ahead with QT, mortgages are attractive relative to investment grade. But in totality, though, U.S. fixed income has kind of risen up to the occasion, has discounted ahead of it. If things were to get worse, yes, spreads will still widen further from here. This is not by any means the end of how wide spreads can go. But at least we have a good cushion already built in.
George, can I ask you about how you think about carrying the risk into the weekend? You always hear that kind of cliche, no one wants to be long going into the weekend. And as I think about it, I wonder what the biggest risk is right now, de-escalation or escalation, given the dislocation we've seen in markets worldwide. George, what do you think the bigger risk would be?
Look, the fact that we're still going out in the wides in most spreads, especially with Europe closing, and just spreads in general in the dollar funding markets showing signs of stress, and CP markets, if that continues, I think over the weekend there's going to be a lot of just rethinking about what happens next week, because it'll be going on the third week. Do we get an escalation in the conflict? What does it mean for the financial markets? So I do think it's still worried about escalation, not de-escalation.
Francis, how do you think about the same balance of risks?
Well, for me, the big risk is, do we actually see central banks that pivot or blink in the coming weeks? Do we get a dovish hike on March 16th? And this is so important because we need to see an elongation of the cycle and we need to see a re-steepening of the curve. That's the biggest known unknown. And it's also one of the parts of the story that can fluctuate very quickly. So as you know, I have a dovish forecast that's based on the idea the Fed can't hike as much as they'd like to. That's actually bullish on a longer term perspective. So for me, we're still very firmly focused on central banks that are too hawkish going into declining growth. That's a problem.
We've got to look ahead to next week as well. We'll do that in just a moment. George, Robert and Francis sticking with us. Just a headline here from S&P. S&P to remove all stocks listed and or domiciled in Russia. Let me go through that again. S&P to remove all stocks listed and or domiciled in Russia. S&P Dow Jones to remove Russian stocks prior to the March 9th open. That headline just crossing just seconds ago. Coming up, the final spread, the week ahead, featuring US CPI and an ECB rate decision and news conference within the same hour. That's next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, Eurozone GDP. Coming up early in the week on Tuesday. Some data out of Asia on Wednesday, including China CPI and PPI. Then a big Thursday with an ECB rate decision followed by Christine Lagarde's news conference, plus the big one in the United States. Seconds before Lagarde speaks, US CPI. Back with us, Francis Donald, George Goncalves and Robert Tipp. Still waiting for the president. A long list of people in front of him doing some long introductions. Some headlines we got just moments ago. I'll recap them for you. S&P to remove all stocks listed and or domiciled in Russia. That will take prior to the open on March 9th. S&P Dow Jones to reclassify Russia to standalone from EM. Another one came from the US. Russia should allow Ukrainian plant to operate. This is the nuclear plant that came under fire yesterday evening. The US saying that they should allow shift changes at Ukraine's nuclear plant. Some of the headlines we've had just in the last couple of moments. Let's get to the guests, shall we, and get to Thursday. And Francis, I just want you to set the stage. Thursday morning, 8:30 Eastern, CPI drops, Lagarde comes out. I just wonder what's going to happen on that morning. What are you looking for?
Well, let's go back to the theme of what we already knew. This is what we need to know about the future. US CPI, we know it's going to hit about 8%. February was supposed to be the peak mathematically, but now with energy prices rising, we're going into March. All economists will be looking for what we've been looking for the whole time. Breadth of inflation is going to be problematic, but make no mistake, there's going to be no cover for the Fed to turn much more dovish after this print. They're going to have a strong jobs number, very strong inflation. They're going to feel panic. The ECB is more interesting, certainly from my perspective, because they're at the center of this stagflation storm.
I've got one eye on the president's feed, and I think I'm just going to go through it and squeeze in the final round. Let's do that right now. 3 quick questions, 3 quick answers. How many hikes this year? I wonder how the story's changed. How many hikes this year, Francis?
3.
Robert?
5.
George?
3.
Peak in the Fed funds. The peak in the Fed's funds. 1 handle, 2 or 3 plus. 1, 2 or 3 plus, George?
1.
Robert?
1.
Francis?
1.
Let's squeeze it in. 7 handle or 8 handle on CPI. 7 or 8, Francis?
8.
Robert?
8.
George?
High 7s.
Brutal. Francis Donald, George Goncalves, Robert Tipp, to the three of you, thank you very much. From New York, same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.